and welcome to Beacon Wealth's monthly market commentary. I'm Hillary Sunderland, Chief Investment Officer at Beacon Wealth Consultants, and this segment is dedicated to keeping you informed of what's going on in the current market environment. I'm going to start with a quick overview of the economy and then talk briefly about what's been going on in the market over the last few months. Gross domestic product is the value of all finished goods and services produced in a country over a specified time period, and it's commonly used as an indicator of the overall economic health of a country. And this is one of the things we look at on a consistent basis because a significant change in GDP, either up or down, can have a big effect on the stock market because a bad economy usually means lower earnings for companies, which translates into lower stock prices. And the good news, which you can see on this chart, is that U.S. GDP came in at 4.2% in the second quarter of 2018. And this is actually the highest reading since the third quarter of 2014. In addition to that, corporate profits remain robust, inflation continues to be stable, and the labor market remains tight with the unemployment rate still below 4%. So the key takeaway here is that the U.S. economy remains strong. We don't forecast a recession occurring in the next 12 to 18 months unless there's some trade-related shock. And because the U.S. economy remains strong, that's typically fairly good for the U.S. stock market going forward. We've certainly seen how this backdrop has been good for U.S. stocks. This is a chart of the S&P 500 index, which is a measure of the return of large cap stocks that are located in the U.S. And one of the things to note here is this yellow line that shows the trading range we were in since the beginning of the year. And what I mean by that is early in 2018, in January, we had a high, then we had a big drop off in February, and then the markets moved sideways for 2 quarters, clear through the summer. And finally, near the end of the third quarter, middle of the third quarter, rather, we broke out of that trading range to the upside. And that is good for stocks. We're seeing some broad-based participation in the move higher. And this break out of the trading range is good because that means that it's likely that we'll see another leg higher going forward. The 10-year Treasury is a key measure for what's going on in the bond market, and this shows 10-year Treasury yields going back to the 2008-2009 time period. One of the things to note here with this yellow line is that at the end of the quarter, the 10-year Treasury ended up a little over 3%, which is a high not seen since the beginning of 2011. And because we are on this trend upwards in yields, we've seen some declines in the prices of bonds. As interest rates rise and yields move up, the price of bonds falls. And that can be a little disconcerting for especially more conservative investors because that hurts. You have some unrealized losses in your portfolios. But it's important to remember that at the end of the day, the income you're collecting is going to be one of the big drivers of your future returns. When those yields are rising over the long term and moving forward, that's actually going to help your portfolio over time. So while we may be experiencing some short-term pain as interest rates continue to rise, just encourage everyone to hang in there. Hopefully better days are ahead as those yields adjust higher. So far, year to date, the story has been in domestic stocks. You can see here in the yellow and red bars that domestic large cap stocks and small cap stocks are both up double digits year to date. However, international stocks, which is shown by that gray bar there, are down a little over 3%. Bonds, again, have had a tough year. The Barclays Aggregate Bond Index, the green bar, is down negative 1.6%, and commodities are also down about 2%. So what this means is that for diversified investors, while the headlines on the news stations are all that the markets are reaching new highs, we've seen double-digit returns year to date, properly diversified investors are going to have exposure to international stocks and bonds and some alternative type asset classes such as commodities. And so your average investor is likely not going to have double-digit returns year to date. You're likely somewhere in a maybe 4 to 6% range for a more balanced type investor. However, over longer periods of time, diversification is the prudent thing. It's encouraged in scripture, and that's one of the things that we do here at Beacon Wealth. So what do we see kind of going into the fourth quarter of 2018? Absent a trade-related shock to the economy, the economic backdrop remains very strong, and that's a positive for the U.S. stock market. Right at the end of the quarter, we were able to forge a deal to salvage NAFTA. It's now known as the United States-Mexico-Canada Agreement. And with this, it's going to avoid tariffs. It will make it harder for automakers to build cars cheaply in Mexico, but the agreement overall is aimed at bringing more jobs in the United States. And the positive thing about this agreement really is that the Trump administration has been able to negotiate some better trade terms. And so if this can also translate into better terms with countries such as China, that can be good for the markets as well. We do expect on the bond side that interest rates are likely to rise further, and that's likely going to result in some weak returns for some fixed income asset classes over the short term. However, in our Light Point portfolios, we've positioned the portfolios to try to hedge a rise in rates. There are parts of the bond market we can invest in that aren't as sensitive to increases in interest rates, and so we are investing in that as appropriate. And overall, we remain cautiously optimistic for the rest of the year. U.S. stocks remain slightly expensive relative to history, but they're still cheap relative to bonds. And so we do think that over the next few months, while the pace of returns may slow a little bit, we think absent some trade-related shock to the economy, that we should end 2018 on a good note. Overall, we thank you for your continued confidence, and that, as always, please reach out to us with any questions you may have.